Interest rate increases by central banks are major news. According to the bank, the only method to combat inflation is to keep hiking interest rates, which will increase borrowing costs. Rising interest rate could affect the entire economy. It can undermine consumer confidence, reducing demands, layoffs, reduced wages, and falling stock prices. They risk pushing economies into a recession if they advance too quickly. So why do central banks raise interest rates? In today's video, we will discuss the peculiar relationship of inflation and rising interest rates. If you are new to the channel, make sure to like and subscribe. It has been more than 70 years since Americans were able to reduce inflation from a level of above 5% without triggering a recession. Since it keeps the economy running at a reasonable pace, a little inflation is acceptable. Overly prolonged high inflation, however, is problematic. Higher prices mean employees will need higher wages, which would push up costs for businesses that could drive up prices further and potentially leading to an upward spiral of wages and prices. Setting expectations for inflation is a major concern for central bankers. The argument is that if it can demonstrate that it will always take action to bring inflation back to 2%, then perhaps it won't need to raise and reduce interest rates in such a seesaw fashion. So again, why do central banks raise interest rates? Let's begin with the basics. To make borrowing money profitable for the lender, you'll need to pay back a bit extra. The extra is the interest rate. Therefore, you want the interest rate on a loan to be as low as possible so you don't have to pay as much back. On the other hand, a high interest rate means you can earn more on your savings if you wish to save money. Consider it a price for maintaining a balance in your account. However, the specifications for your reward will determine its amount. In the economy, there is no single interest rate. Numerous banks are setting their own commercial interest rates, but the interest rate that the central bank sets has an impact on all of that. Similar to a bank is a central bank. Banks receive interest rate when they deposit money with the central bank, much like you do with your savings account. Reserves are items that commercial banks have, so that's comparable to their available cash. Commercial banks can deposit their excess reserves at the central bank as well as lend such reserves to one another at interest, and they can get paid interest for doing it. The interest rate on the excess reserves is not accessible to the general public, but the point is that it still has an impact on them. Inflation, or how quickly prices grow for everyone, is what central banks are attempting to manage when they raise interest rates. All major central banks, including the Federal Reserve, the Bank of England, and the European Central Bank, are aiming to achieve a 2% inflation rate. They have a fairly effective instrument for doing that, which is interest rates. The moment banks increase interest rates is when inflation is deemed to be too high. The alteration permeates the financial system and reduces inflation. How? A commercial bank will make more money on its reserves if a central bank raises its interest rates. If they kept their money in a central bank rather than lending it out, they might profit more. In order to make it worthwhile for them to lend it out, they will therefore raise their interest rates. The economy will determine how that impacts consumers. Consider mortgages. Numerous people hold mortgages with variable interest rates in countries like Finland or Australia. If you have a variable rate mortgage, the interest rate you pay is determined by the interest rate set by the central bank. Therefore, higher borrowing rates essentially immediately translate into less money available for other uses. Households will spend less if they have less extra money, and less spending implies companies will be more cautious about raising prices. This ought to reduce inflation. The majority of mortgages have fixed rates. Fixed rate customers are shielded from the immediate effects of an interest rate increase, but will still experience a side effect. Mortgages will cost more for new home buyers as interest rates rise. House prices will start to decline and everyone who owns a home will feel poorer, and as a result, they might spend less. Lower spending will translate into lower inflation. Not only consumers will tighten their budgets, businesses will also find it more expensive to borrow money and make investments as interest rates rise. Typically, less economic activity results from this. It could result in fewer jobs being produced. Lower earnings and fewer jobs might leave people with less money, which could undermine consumer confidence, which translates into lower spending. Real wages have fallen, which means that people's incomes are now worthless. Interest rate increases tend to slow down investment, expenditure, and overall economic activity. Overall, this will make companies more hesitant to raise their pricing, which will tend to hold inflation in check. It sounds simple enough, right? The tricky part is determining how far to go. Increasing interest rates can drastically slow down the economy. The brake pedal has a delay, which is the problem. The full impact of interest rate changes may not be felt for up to 2 years. Central banks are aware of this. Consequently, they attempt to read the future when they set interest rates, but foreseeing the future is not simple. The issue is that central bank finds it challenging to determine if inflation will decline on its own. And even when central banks do make the right decisions, a crash could still happen. Raising interest rates is the primary weapon used by central banks to control inflation, despite the fact that it is a blunt instrument. The answer, according to central bankers, is that hiking interest rates can be painful. It's not enjoyable to slow the economy down, but it is worthwhile. It is worthwhile to achieve minimal and consistent inflation so that you won't have to worry about it in the long run. As usual, if you learned something valuable, please make sure to like, subscribe, and hit the notification bell for more contents like this. You can check out more videos on the channel and share. See you in the next one.